Ladies and gentlemen, good day and welcome to the Ahluwalia Contracts India Limited Q2 FY25 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dhruv Jain from Ambit Capital. Thank you, and over to you, sir.
Thank you. Hello, everyone. Welcome to the Q2 FY25 earnings call of Ahluwalia Contracts India Limited. From the management side, today we have with us Mr. Shobhit Uppal, Deputy Managing Director, Mr. Vikas Ahluwalia, Director, and Mr. Satbeer Singh, Chief Financial Officer. Thank you, and over to you, sir, for your opening remarks.
Thank you, Dhruv. Good afternoon, everybody. Ahluwalia Contracts India Limited has announced financial results for Q2 FY25. During this quarter, Q2 FY25, the company has achieved a turnover of 1011.48 crores and a PAT of 38.36 crores in comparison to a turnover of 901.55 crores and a PAT of rupees 55.30 crores in Q2 of FY24. The company has registered a growth and degrowth of 12.19% and minus 30.63% in turnover and PAT respectively during Q2 FY25 in comparison to Q2 FY24. EPS of the company for Q2 FY25 is rupees 5.73 as compared to rupees 8.26 in Q2 FY24. During Q2 FY25, the company's EBITDA margin is 7.25% as compared to 9.96% and a PAT margin of 3.79% as compared to 6.13% in the corresponding period of the last financial year. During the H1 FY25, the company has achieved a turnover of rupees 1930.83 crores and a PAT of 68.96 crores in comparison to a turnover of 1665.16 crores and a PAT of rupees 105.03 crores in H1 FY24. EPS of the company for H1 FY25 is rupees 10.29 as compared to rupees 15.68 in H1 FY24. During HY1 FY25, the company's EBITDA margin is 6.93% as compared to 10.36% and a PAT margin of 3.57% as compared to 6.31% in the corresponding period of the last financial year. Net order book of the company as on 30th September 2024 is 16,193.45 crores to be executed in the next 2 to 2.5 years. Total order inflow during FY25 till 30th September 2024, 6699.70 crores. From 1/10/2024 till date, 1094.67 crores. So total order inflow in this financial year till date is 7794.37 crores. Thank you. We are ready to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Thank you, sir.
Hi, Shravan.
Hi. Sir, just to recheck on the guidance front. So now for this FY25, in terms of the revenue growth and for FY26, how much growth are we looking at? And also possibly on the margin front, given the margin was very low in the 1H. So in the second half, how much margin are we looking at? And in FY26, will it again go back to 11%?
So as far as our top line growth is concerned, we are sticking to a guidance of about 15% growth. As far as our margin is concerned, we feel that we'll have to moderate it a bit. It will come below double digits now. It will be around 9%. As far as the next financial year is concerned, since our order book is healthy and a lot of our design build projects we feel will be in full swing in the next financial year, we should cross the double digit margin barrier in the next financial year, that is FY26.
Okay. And in terms of the revenue, will it be in FY26? Can we see more than a 20% kind of a growth?
Yeah, it should be between 15 to 20%. We are targeting a 20% growth.
Okay, got it. And in terms of the order inflow, now already we have received a significant 7,800 odd crore, including the recently one. So now how much more are we looking at by March? And if possibly, if you can share in terms of the bid pipeline, and our long-term vision was to have a 50-50 private government, which we are already there. So how we want to now go ahead?
Yeah, that is what I've been mentioning in our last 2 or 3 con calls, that we would like to maintain it at this level, at a 50-50 level. And going forward, we are actually consolidating. So in the rest of the 3-4 months of this financial year, we are not bidding very aggressively, maybe another 1,000 crores inflow. And going forward in the next financial year, maybe anywhere between 5,000 to 6,000 crores new orders.
Got it. And currently the bid pipeline would be?
Currently the bid pipeline as it stands is about 5,000 crores.
Got it. And just a couple of data points on the balance sheet front, mobilization advance, retention money and unbilled revenue.
Yes, mobilization advance is 542 and unbilled revenue is 598.
Okay.
And retention is 335.
335. And just on the capex front, so already 92 odd crore done. So once
capex till 30 September, 101 crore has incurred.
So for full year, how much now we are looking at?
We've given a guidance of about 130 crores.
175.
175 crores. And then the rest of the financial year, it should be about another 30 to 35 crores. That also we're revising it downwards.
Okay. Got it, sir. Thank you and all the best, sir.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. We have the next question from the line of Amit Khetan from Laburnum Capital. Please go ahead.
Hi, sir. Thank you for taking my question. So, we have a good order book currently, but if I were to look out over the next 2 to 3 years, what are the segments or areas you are most bullish on in terms of incremental new orders? Are there going to be new areas that we will participate in, or is it going to be the current segment that we are in?
So, Amit, we are, as you would be aware, we are present in the entire spectrum of the building industry. So, there are areas, over a period of time, which we had not focused on because there was not much activity. We are now refocusing on industrial activity. We've recently won an order with Balco also. Airports is something which we continue to be bullish on. The government is continuing to spend on airports. So we already are executing 2 airports which are in designing stage as we speak. And there are a couple of orders in the pipeline which we are bidding on. So that is another area that we're looking at. Commercial and retail activity is something that also excites us. We are focusing on that. So these are the areas. And residential activity, there is a lot happening, but we are now being a little wary. We already have a healthy exposure as far as residential projects go. So we are bidding sort of conservatively going forward as far as residential is concerned.
Got it. And these, this industrial sector that you talked about in airports, right? What are the typical order sizes like? Are these in the similar ticket size range of 500 to 1,000 crores, or would they be much larger?
No, they are in this range only. As far as office infrastructure goes, the government is also coming out with larger orders for government office buildings using alternative technology. They are 1,000 plus crores. That is an area which is of interest to us.
Understood. And secondly, in the last couple of quarters, you've been talking about a shortage of labor and things like that. Has that eased, or do you see that continuing for the next few quarters?
No, that is continuing, on account of various factors. As the country continues to be permanently in an election mode, that's what we've been seeing since the general elections, preparations for the general elections started. So this labor problem continues as labor comes from a few areas geographically, and this continues. Then NGT issues such as NGT and rain, this continues to affect labor supply. So we feel that this will, throughout this financial year at least, and even in the first quarter of next year, this problem will continue to be there.
Got it. And would this also be a factor in margin contraction, or is that just a function of operating leverage?
No, it's a huge factor.
Okay. Got it. That's very helpful. Thank you and all the best.
Thank you.
Thank you. To ask a question, ladies and gentlemen, you may press star and 1. The next question is from the line of Lakshmi Narayan from Tunga Investments. Please go ahead.
Yeah, thank you. A few things. See, when you started the year, you actually alluded to a particular margin, and then we stand at this point in time at a slightly lower margin level, right? Now, what has actually what has negatively surprised you when you actually drew up your budgets start of the year, and whether things have become a little unpredictable now than earlier, and how you think it's becoming a little more predictable going forward?
So look, while one of the things which had surprised us in the past is the volatility in material costs, that we had catered for by building in escalations in our contracts. But, on some of our larger contracts, which we have won in the last year or so, there are various factors which have hit us, which were not within our control. One is, of course, the prolonged monsoon across the country. Some of our biggest projects are in, say, places like Mumbai or Orissa or Bihar, right, where Assam, where the monsoons this year have been exceptionally heavy. The turnover has been affected there. Then, as I mentioned in my answer to the earlier question about, the last 5-6 months, the country has been in election mode. That has impacted the labor force availability on site. So this was something which was not expected. Thirdly, on some of our large contracts, the design part, approval, so to say, has been delayed for no fault of ours, which were beyond our control. CSTM being one such project, which is our largest project till date. That has impacted our margins because our fixed overheads have continued to be there and we've not been able to execute on the ground. So these are factors which have impacted our margins. And fourthly, some of these factors are generic or general to the industry. If you were to compare our margins with our peers, actually we've done better than most of them. So we've managed our cash flows better. But the industry as such has been affected and beset by some of these margins. Going forward, hopefully in the next financial year, I don't think there'll be so much focus on electioneering. A lot of state elections would be behind us. Most of our large projects, the design is nearing completion. Approvals are mostly going to be in place. So hopefully we'll have a clear run and our margins would be on the upswing again.
Got it. And in the last call, you mentioned that there has been spurt in the subcontractors' expenses as well as the employee expenses, or both of them. Now, and you said that only some of your contracts have a pass-through. You can actually pass these expenses on. So, right now, what kind of situation we are in? Has it been, has it been any changes in the contract that you have passed on these expenses, or how situation is looking now?
So most of our contracts now have built-in escalation clauses, one way or the other. As far as the government, most of our fixed price contracts have been completed or are nearing completion. As far as the ongoing contracts are concerned, the government contracts, they have a built-in escalation clause, a standard clause based on wholesale price index. As far as the private contracts go, all the volatile materials, the basic pricing is there for cement, for steel, for grit, stone aggregate, so on and so forth, even the finishing materials like stone, wood, etc. So, as I said earlier, the volatility in these materials is covered. And because we have a healthy order book, to a certain extent, in the private sector, we are able to dictate terms in having a more balanced contract agreement and plugging in these.
Got it. Now, if you just look at your current assets in the balance sheet, and the trade receivables are something like 625 crores. I mean, can you just tell me how do you classify the current assets? How much of them are payable within 6 months? Receivables within 6 months? You can just throw some light on what is the aging of the receivables in your current assets.
What I could understand that there is basically 625 crore debtors. That's as current receivable, and that we are expecting within our normal days, operational days, that's coming around 60 days, 60 to 75 days. That we are expecting to receive that.
Yeah, 1 second. We'll give you more than 6 months.
And this is non-current, this is hardly 33 crores. I think so. We are expecting
I'm looking at the current assets, sir.
Yes, please.
Current.
I'm looking at the current assets, trade receivables is around 625 crores. I just want to understand how much of your trade receivables are within 6 months and how much is beyond 6 months to 1 year. Less than 6 months and 6 months to 1 year.
This is 600 out of 625. I'm expecting around might be 100 crores more at upper side, just more than 6 months.
And rest 525 crores will be within 6 months.
Yes, sir. Less within 6 months. Yes.
Okay. So one more question regarding your you talked about fixed costs are slightly estimated. Now, if I just look at your expenses, which are the ones that are variable in nature? So if you look at it, the subcontract work is completely variable in nature. And how about the employee benefit expense? How much is variable and how much is fixed?
Variable, as far as employee cost is concerned, variable is very less. As far as the variable is concerned, it's only for the top, maybe out of a total employee strength of about 3,500, variable component would be only there for about 20 people who are the top levels of management in the company.
Because your employee benefit expenses have actually kind of gone from around 70 odd crores for the first quarter, and to that almost 89 crores. So just want to understand what actually led to a substantial increase in the employee benefit expenses.
So two things. One is our employee cost includes labor cost also.
Okay.
So this is the labor which the company is spending directly on.
Okay.
So there are two components to the labor. One is labor which is under the subcontractors. And as a part of this 89 crore, there is labor which the company is directly spending on.
Okay. Okay.
Part of this increase is due to the increase in revenue. And part of the increase is also sorry?
Out of employee benefit, 22% is labor.
Yeah, so that's what I'm saying. And the other big thing is we have increased, we have paid arrears to the staff increments. Our staff increments, we put those increments in the last quarter, and the arrears have been paid. Right? This was due from 1st of Jan, but the process was delayed. So part of that is increases due to that. And thirdly, obviously, the number of people, the number of staff has also increased to cater for our increased order book, where we are going to be executing the work over the next, say, 2.5 years.
Got it. And any idea what is the band one should expect? Because there is like a one-off areas which has been taken into consideration. So, employee benefit,
just to give you an idea, our staff cost per se, only our staff cost, if that is helpful to you, is in the region of, it varies from about 6.8% to 7.1%. And this is where it's been kept at over the past, say, 2 to 3 years.
Got it. And that this is part of the employee benefit expense.
Yes, this is a part of the employee benefit expense.
Got it. Thank you, sir. I'll come back to you.
Thank you.
Hi. 1 minute. Can I just... hello? Are you there?
Yeah.
Yeah. Okay. So you asked about specifically a question about the trade receivable, right? So our trades are about 60 days, as Mr. Sarvesh said, right, which is one of the lowest in the industry today, right? I mean, it goes on up to about... So we have reduced also our net working capital days have reduced from 117 in the last quarter, that's Q1 of 25, to 93 days in the current quarter.
Okay.
Yeah. That's additional information to you.
Thank you. Thank you.
Thank you.
Thank you. The next question comes from the line of Parvez Qazi from Nuvama. Please go ahead.
Hi, good afternoon, sir, and thanks for taking my question.
Hi, Parvez.
Yeah, hi. So a couple of questions from my side. As you rightly said, historically, our staff expenses have been between 6.8 to 7.1, whereas if one looks at H1 numbers, they are at about 8.8 or something. Now, clearly, part of the reason is because of operating big leverage. As you rightly said, some of our projects, because of various reasons, haven't progressed at the pace at which we would like. So maybe part of the reason is also because of the industry-wide labor shortage. Now, going ahead, do you think we should pencil in slightly higher than historical average for this, or do you think this will normalize and come back to the 7%, 7.5% mark, maybe 1 year down the line, 2 years down the line? Just wanted to get your thoughts on that.
We aim to get it down to anywhere between 7 to 7.5%. That is what our planning is. But as I mentioned earlier, and you also sort of alluded to that, it all depends on our revenue, on our actual execution on the ground. Other than the factors that I've mentioned earlier, which have affected our work on the ground or production on the ground, one factor which will continue to impact us in this quarter, the ongoing quarter, is the NGT. Right? All of you are aware of what's happening in NCR. So now GRAB 4 is in place. And so that is another this thing which is going to impact this quarter. That's why I've kept the margin guidance muted for the rest of the year, because we have a lot of large projects in NCR, especially Gurgaon.
Sure. My second question is, you said that for the CST redevelopment project, there are, design issues, and which hopefully will get resolved going ahead. But if you look at some of our other major projects like the Tata Memorial Hospital in Parel or the DLF Arbor project, there also the quarterly execution run rate seems to be somewhere around 25-30 odd crore only. In these projects also, are there some design issues or some other issues, and when do we expect a pickup in the pace of execution for these larger projects?
As far as the DLF Arbor project goes, we actually executed about 11 to 12 crores per month. For last month, we achieved that run rate, and this month we were on a target to double that, and then going forward maintain about 25 crores every month. But this quarter, as I said, now it will be impacted by NGT. But we are out of the ground there now. The design issues, the design was not in our scope; it was in the client's scope. But there were a few issues there, and labor shortage was there. But I think, as far as DLF goes, once the NGT issues are behind us, we are ready to take off. As far as Tata is concerned, there were design issues, but that also, I think, within a month or so, we should be taking off on that project also.
Was a Tata Cancer Hospital is nearly on target now. I mean, whatever time we've lost is because of the monsoon.
Sure, sir.
So whatever were the design issues, they were more to do with the foundation part of it, which the Tata Memorial people had to redesign or do a little bit of changes, because we encountered a certain block which was not there. So that is the otherwise Tata per se is on track.
Sure. My second question is, the overall industry, when we talk to real estate developers, they do highlight that there is a shortage of good quality contractors in India. You, as well as some of your other peers in the building contracting space, clearly have lifetime high order book. There is no shortage of order intake. So then the question is, in the previous cycle, 2002 to 8, we had seen a similar phase, and all of you as well as your peers had seen significant expansion in EBITDA margins. Why do you think the similar situation is not playing out this time?
It's too early, to sort of say whether those kind of margins will happen or not happen. All we can say is, or to give you the reasons for why they have not happened up until now, as far as this financial year is concerned. I did mention all those reasons, prolonged monsoon, electioneering, right, and all of a sudden the infrastructure growth is upon us, and this kind of growth is unprecedented. This was not even there in the last upturn. So labor shortage, the kind of labor shortage that we are seeing now, I mentioned in my last two calls that this is virtually an epidemic which is waiting to be upon us. So the government has to wake up and do something about upskilling of labor force, do something or change the NREGA laws. So labor shortage, till the government steps in, I don't think anything much is going to happen. So that is a major contributor to works not proceeding on schedule, and that in turn is affecting our not only our revenues, projected revenues, but also our margins.
Sure.
And why the industry is suffering. It's not only us. That's why I mentioned, if you see the results of all construction companies, all these factors have contributed.
Yeah, absolutely, sir. Last question to Sadhbir ji, sir. What would be our gross debt level?
This is 9 crore.
9 crore. Sure. Thanks, sir, and all the best.
Thank you.
Thank you. We have the next question from the line of Vaibhav Shah from JM Financial. Please go ahead.
With the EBITDA margin guidance for FY25, what's the number?
About 9%.
So what will drive that improvement in the second half, the margin improvement?
As we mentioned, some of the factors which have affected us till now, they are behind us. One is, I think, other than NCR, we should have a clear run execution. No monsoons are there. Once the Maharashtra elections are over, that sort of holdback should also not be there. As far as NGT is concerned in NCR, this month or maybe December, maybe a washout, but the last quarter we should see a good run rate. We have most of our contracts have taken off now, and out of our total order book, almost 30% comes from NCR. And our bigger projects like CSTM and Tata, as Vikas mentioned, the design phase is almost over. So we are looking for a healthy revenue from these projects also. The two airports that we are doing, Varanasi and Darbhanga, there also design phase is nearing completion. So in the last quarter of this financial year, we should see a good run rate from these projects also.
Okay. Sir, secondly, out of our total order book, what will be the share of fixed price contracts?
This is 15%.
And this should be completed by March, largely?
You can say, largely this should be completed by March. Almost totally it will be over by H1 FY26.
Okay. And sir, lastly on few projects. So for CST, now what would be our guidance for FY25 in terms of revenue, and earlier we were targeting completion of June 26. So would we be revising the numbers?
Vikas, you want to answer that?
Come again, please.
So for CST project, what would be our revenue guidance for next couple of years? And we were targeting a completion of June 26 earlier. So are we maintaining that target?
So the project is actually about 3.5 years, and the execution time will probably remain the same. Whatever time we've last 6 months, 8 months because of design and approvals from the railways is lost. But it is going to be compensated for that. That is for sure.
Okay, so what revenue are we targeting for 25 and 26 from this project?
You can take an average run rate of about 80 crore rupees. So some months is going to go up, some months is going to come down. So my average run rate is about 70-80.
That should start from fourth quarter onwards, 70-80 crore run rate?
That should start from, somewhere in January, February, it should start.
So to specifically answer your question, as far as this financial year is concerned, we are looking at a turnover of we're targeting a turnover of about 300 crores. And as far as the next financial year is concerned, as Vikas has said, 70 to 80 crores per month would be an average.
Okay. And sir, lastly,
that's about 800 crores, give or take a few crores here and there for the next financial year.
Okay. And sir, when do we expect to start the work on Jewelry Park?
Jewelry Park, we have not yet got the notice to proceed. But we are expecting it in the month of December. We are expecting the notice to proceed. And then again, it will go into the design stage. So let's be fair and square, not to expect much from this financial year itself.
So revenue will start flowing in from next year, second half?
Yeah, next year, second half.
Okay, so any broad guidance for in terms of revenue from the project for FY26?
Maybe about 15 rupees a month. You see, what will happen in this is that by the time the design is going to get complete, trains are going to set into Mumbai, Maharashtra next year.
Okay.
So that is what is going to happen in this case. I'm being very honest here. So maybe next year again an average run rate of about 30 to 50 the first few months. Then again it is going to go up to that level of 70, 80, 70, 80.
Okay. Sir, and lastly, any issues on the working capital side from any particular states?
So, as I mentioned during the last call, Bengal, Bihar were two states. Bihar working capital is actually improved. All our dues have been certified, and we should see, them being cleared in this financial year, rest of the financial year. Bengal, we are not executing any government jobs as we speak. So, and all the earlier jobs have been finished.
Okay, sir. Thank you, sir. Those are my questions.
Thank you.
Thank you. The next question is from the line of Samyak Jain from Marcellus Investment. Please go ahead.
Thank you for the opportunity. Sir, I understand that you are maintaining your revenue guidance at 15% for FY25, but bringing down the capex guidance for the year. So just wanted to understand how will you maintain the pace of execution for this financial year?
It's an internal reworking that we've done. Some of our larger projects, have gotten over, and as I mentioned earlier, we are conservative as far as new order inflow is concerned. So, as a part of cost-cutting exercise that we have gotten into, once we've realized that the margins are down for the reasons as enumerated earlier by us. So we are looking to reduce our CapEx expenditure as far as equipment and shuttering go. We are looking at, as far as shuttering goes, we are looking at maybe going the rental route on some of our projects where we feel, which are fast-track projects, where we can use rented shuttering, a quick in and out. So as a part of the overall strategy to cut costs.
Understood. And if the renting increases, will that further impact the margin, or it will remain in the guided range?
We have an internal, you can say, the way we work out which projects can take renting where the profitability will not be impacted, which are fast-track projects, right? Where, the projects which are to be finished in about a year and a half, at least the structure bit. So there we go the renting route.
Understood. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Sunny Roy, an individual investor. Please go ahead.
Hello, am I audible?
Yes.
Yeah. So I just wanted to know that since we are targeting a 50-50 between the private and the public sector for our orders, what is stopping us from bidding for the private sector more than 50%, given that the terms and conditions are much better and the pay receivables and the margins and all, and competitive intensity is much better against the public sector. So why aren't we increasing the private sector part in the order book?
Nothing is stopping us, but other than the scars of the last downturn. Earlier when the downturn hit the private sector, a lot of contractors got waylaid. They lost. Actually, companies got finished. So we don't want to put a lot of eggs in one basket. And while the going is good today, we, as an infrastructure company, we are always at the forefront of cycles, be it upward cycle or downward cycle. So we're just being cautious.
Right. And sir, lastly, as mentioned by a previous caller, that regarding the earlier cycle of 2002 to 8, if we compare that to this, so where are we in that cycle? Are we in the starting point? Are we in the midway? Where do you feel, even though it's not comparable, where do you feel from the industry standpoint, we are the construction industry compared to the last cycle? Is it in the midway or in the starting point?
I think we are somewhere between the starting point and midway, but it's not. It would not be right to do a strict comparison because when the last cycle was there, the geopolitical situation was something else. Today the world is flatter. What happens in America impacts us immediately. So it would not be fair to do a direct comparison. If you would have asked me this question 1.5 months ago, I would have said we are just at the starting of the cycle. But today, I would like to say we are somewhere between starting in the midpoint.
Right, sir.
So we have to be cautious. That's what I'm saying. Anybody who's not cautious, who throws caution to the wind and, indiscriminately plans to grow, that's what actually we are seeing. There is a plethora of issues which are coming out from construction, for construction companies and in the real estate sector. So we don't agree with that line of thought. I think one has to be cautious going forward.
Right, sir. So thank you for the strong execution and the prudential approach. I've always been a long-term investor, so I wish you all the best, sir. Thank you.
Thank you so much. Good to hear that.
Thank you. Ladies and gentlemen, if you wish to ask questions, you may please press star and 1. We have the next question from the line of Ketan Jain from Avendus Spark. Please go ahead.
Thank you. Sir, my question is on the MR settlement. How much of the money is received and yet to be received?
I think it's 56 crores to be received now. All money, total is 218. Out of this, 56 crores is to be received now.
Oh, 54 is pending. 56 is pending.
The tranche that was to be received in this quarter has been received. That has been received, so that the payment is happening as per schedule.
And how much in this quarter is it?
This is 70 crores.
70. So it will get done by FY25?
Yeah. Next tranche is due in January. The last tranche.
January. Okay, sir. So my second question is on, so I was just seeing your P&L in FY19, 20 and 21. We have had a big bad debt provision, bad debts written off in FY20 and FY21 worth of 42 crores and 53 crores. If you could tell us, what does it pertain to? Which client does it pertain to?
That is also related to MR also. That time we have taken provision of 47 crores and various other parties was there at that moment. That like Krish or various parties are there.
Okay, so it's largely MR and other parties.
Largely MR, yes, exactly.
Okay. Okay, thank you, sir. I'll get back into the queue.
Thank you. Ladies and gentlemen, we have no further questions at this time. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you so much, everybody, for joining in. See you soon in about 3 months' time. Thank you. Thank you so much.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.